Yeah, hi, Rajat. Good morning.
Hi, good morning. So, Mayank, I'll just wait for you to tell me when to start. I know, no worries. So, who's Erudito? India? Yep. Somebody's gonna steal all our startup secrets on today's call. So,
No, I think they will put it in their business to
ah,
grow. So that's the intent.
right, right, right.
Rajat, you will be setting up the agenda, Mangji. I think so.
Sorry, I'll be what?
No, no, you will be setting up the agenda of this call, what all we are going to cover, the introduction and all, right?
Yeah, I'll do that. I think
Yeah.
Mayank just wants to wait for a couple of minutes.
Oh, sure, sure. Please,
So
yeah.
yeah,
Okay,
once.
take your time. Take your time. Thanks.
And Vishal, आपका HPTI affiliation क्या है?
Yeah, actually, so Rajat, I'm in computer sciences 89 batch pass out.
Oh, nice,
I'm 58 years old now, and I'm working for Ministry of Electronics and IT in Delhi,
nice.
based out of Mumbai. So keep shuffling between Mumbai and Delhi since last year or so,
Very nice.
driving some digital projects for India.
Awesome. Awesome. Yeah. So for those who just joined, we are just waiting for. Mayank wants to wait a couple of minutes to see if other people join. All right. तो ये सेशन तो particularly जतिन के रिक्वेस्ट पे हुआ था. जतिन is not joining. I'm just kidding. Yeah. Okay. Sure. Thank you. And are you guys able to see my screen? Really?
Not
Great.
yet.
Okay. Now?
Yes.
Yeah.
All right.
Yeah.
Okay. So okay, so I hate doing slides. So this is not a fancy presentation or anything. And my intent here for today is to just do a couple of things. One, we'll make it, I mean, we have a close affiliation. We all went to HBTI. We have fond memories. So we'll keep it very informal. Think of it more as a discussion amongst friends. And feel free to make it a very interactive session with questions, observations, whatever, right? So we'll keep it very, very informal. So, quick intro, I'm HBTI Computer Science 97. And then I came to the US to get a master's in computer science and eventually got an MBA. And for the most part of my career, I've been working in tech, variety of tech companies. I've also done startups. Uh, as I haven't spent a lot of time on this. I literally spent like no more than like maybe 45 minutes on this. So things may be a little chaotic as we move along, but hopefully, maybe not. Uh, so my intent here is to essentially cover a couple of topics. One, we'll just talk about some basics of startups and startup land. Two, I'll tell you about my own startup and what was going on and how did I build it and what happened and blah 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 and all. Uh, and then like I said, we'll just keep it very interactive and do some Q&A. So how does that sound?
It sounds
Good,
great.
Rajat.
Good.
Yeah,
Okay.
thank you.
Okay, great. So let me start by just asking, have all of you? So I'm assuming everybody's heard the term entrepreneur. Are all of you familiar with the term entrepreneur?
Not really.
Okay,
We can
so
guess about it, probably. Rajat.
right.
Yeah.
So I made a simple observation yesterday, which is, I think it's great that Mayank and others have kind of started this WhatsApp group, and I didn't realize there are 171 members in that group. That is not reflected in, whether you look at that startup directory or the people, who are available to help or even the discussions that happen, right? And actually, that was a little bit of an interesting point because that is what you actually see out there in the practical world. I'm particularly here in the Silicon Valley. So I'm based in California, Silicon Valley, and literally everybody you meet is doing a startup, or at least that's what they say, right? And really, what ends up happening is a lot of people get enamored by entrepreneurship and startups, and a lot of them kind of want to do it, but they're kind of pretending to do it. They're not doing it seriously. So that's those people are typically called entrepreneurs, which is, hey, I really want to do a startup, but I don't know if I'm doing it because I'm trying to get out of a bad situation. Am I really 100% committed to it? Am I willing to make sacrifices? So on and so forth, right? So so I think all of us, should kind of figure out, are we entrepreneurs or are we entrepreneurs? And be intellectually honest to ourselves. Because if you really embark down this path, it's significant cost. It's cost for you and it's cost for your family and it's cost for your loved ones and all of that. Right. So I don't think anybody needs to answer here, but it's something I would urge you guys to kind of, be intellectually honest with yourselves and try and figure out. Uh, Okay, so the next thing I just wanted to touch upon was I'd love to kind of maybe get a few of you to tell me what do you understand when you hear the term startup. So I have some examples up there on that slide. So if somebody wants to set up a factory to manufacture airplane tires in India, would that be a startup? Anybody?
I think yes, but it's an interesting question.
Okay,
Oh,
so
yeah,
I
yeah.
okay, I want to set up a gym. Right? I mean, lots of people in India are getting into fitness. I want to set up a gym, and I'm looking for investors. Is that a startup?
No, I believe that's not a new idea, right? Uh,
Okay,
there are a good
interesting.
number, yeah, there are a good number of gyms already. So why someone will be interested in your venture until unless you offer something unique?
No, but
Right.
then it doesn't mean like if you have a unique, then only it will be called startup. Is it
I
like that?
mean, yeah, if you're going for angel investors, so I believe they will see some uniqueness in your product, right? Or whatever exactly you're planning to do.
Right.
I think
For
startups are
sure.
those which are venture backed. Yeah, I mean, which, but I'm not sure. The businesses.
Right. Right.
So, but
So
startup
so
are bootstrap as well. So, there's you
correct.
cannot define
So
or make bound them in a boundary.
right.
So
So I
yes,
think I
anything if anybody has something to do and they want to start, so whether it's manufacturing, tire or gym or anything, right? Even consulting services that would qualify for a startup.
fair enough. So I think all of those are correct. Startup is a very very general term, right? So all of those definitions apply. And an entrepreneur is just somebody who's doing something new, right? So starting something new. So if I'm setting up a gym, I'm definitely an entrepreneur. If I'm opening a grocery store in my neighborhood, I'm an entrepreneur. Uh, but generally speaking, and this is the reason I kind of put this slide up was that uh, we don't want to get into academic discussions about what is or what is not. We want to kind of see if we are in the same place with respect to what we think is the relevant definition of a startup, right? So the whole excitement about startups that exists in the ecosystem, regardless of whether it's America or India or what have you, is the concept of a venture backed startup. Okay. So what that means is that on day one, somebody said, well, startups could be bootstrapped, sure. But is the intent, are you building a kind of new entity where you believe down the line you're going to go to a venture capitalist and raise money? Right? So that's when people say startups, generally speaking, the excitement, the buzz, the money that's flowing, the valuations, all of that, they're really talking about venture backed startups, right? So if I want to set up a gym, I will go to a bank and I will, say, hey, here's some collateral and are you going to give me some money? Right? I'll give them a business plan, so on and so forth. Same thing with a grocery store, right? But a VC is never going to fund a gym. They're never going to fund a grocery store, right? Does that make sense? Would you
Yes.
would you guys agree that most of you here are really yeah, okay? So if I set up a grocery store, that could be a really good lifestyle business for me, right? I could maybe even make like 1 crore, 2 crores, 5 crores a year, and I could run that for the next 30 years, pass it down to my kids who run it for generations. But that is not what a venture-backed startup is.
Sir, it can be a venture-backed startup. Say, for example, when Haldiram started, right?
Hmm?
So when Haldiram started, or say Bikanerwala started,
Yeah,
so they started with one single store,
yeah,
right? And
yeah.
eventually, over the time, they turned into a franchisee model, and eventually they are backed by some VC, right? So it depends where exactly you end. But your definition, I do agree. Yes, startup in the mind, if you have some intent to be backed by a venture capitalist and make it big, yes, it qualify for startup definition.
So really good point. You're not incorrect, but there's a subtle difference. So when companies like Haldiram, for example, they want to grow and they want to build their franchise and so on and so forth, there are people who will invest. There are institutional investors, but typically those are the private equity guys. They're either growth capital guys or they're private equity guys. So, like, you typically won't go to a Sequoia or a Kleiner Perkins and say, hey, I really want to just set up a chain of grocery stores. Are you going to put money in? Right? So you're right. There are institutional investors who will give you money, but typically they tend to be the PE guys or the growth capital guys rather than your Sequoias and Kleiner Perkins who are really the VCs.
So Rajat, I have one question here, right? So
Mhm.
coming from same perspective of
Mhm.
like the time of entry is also important because you know what, if we start, can we put on the mute, please? Hey, Vikrant. Yeah, thank you. Right. So so the timing is very important. Timing in the sense, if we have some idea, right, and we start with a bootstrapping, right, maybe family friends also. So after validating the idea, having few customer base and all that, that's gonna take a year, maybe year and a half, maybe two. And by then, you have validation done, you have a customer base, what you can go to the venture and present your case. That way, you can get a very good valuation out of the part, what you want to be part out of it. Because early on, if you go to the venture capitalist or something, in that case, you might end up losing a bigger percentage of your business and losing. And I totally agree at the same point, because I have seen a lot many shows and all that. They say that 1% of 100 versus 1% of a billion is a very big difference. So you don't have any business as of today, but if you bring in a venture capitalist early on, then that can bring $1 billion into it. So even though you have a 5% of the business, that the 5% of the billion will be a great or a
So,
100%.
let me interrupt you. Sorry, let me interrupt you. Hold on to that thought. I think what you're saying is interesting, but right now all we are talking about is we just trying to kind of align people around. Hey, generally when we are all getting together and talking about a startup, we are not saying, hey, let's open a grocery store or a gym. We are really talking about building a startup that a traditional VC like Sequoia or Kleiners or whoever is willing to fund.
So in my understanding, and maybe in the principles of startup, right? It's basically saying, yeah, I'm going to start something with a bigger vision, and I probably need that. I mean, one other factor I would look at the startup is scaling. So I'm starting somewhere. So for example, setting up a gym is like end goal, right? That there's no vision, no scaling, nothing, right? So that way I will take it more like a business, right? Grocery store again has a very limited end goal and setting up a factory. It's not about scaling. It's not about taking a vision from somewhere where we can say it's starting.
So let
But
me
then
give you an example. Let me give you an example. So JP Morgan and a bunch of these banks, they're not VCs, right? So hopefully you guys know they're not VCs, but they're very large banks. JP Morgan has a very huge infrastructure fund in India, right? So as you know, India is doing a lot of stuff in infrastructure. They're building roads, railways, bridges, airports, railway stations, all of that stuff. So there's a huge multi-billion-dollar fund that JP Morgan has. It's an infrastructure fund, and it's basically private equity money, right? So look, I mean, scale and all of those things are fine. I'm just saying that your typical Sequoia, like if you go to a Sequoia and say, I'm going to build roads in India, right? Sequoia, would you put in money? Kleiner Perkins, would you put in money? Those guys don't do that stuff, right? Because their idea of investing in an entity and how they make money out of it is very different from what the private equity guys do, right? And okay, so let's move on. We can come back to this one, right? But regardless of whether it's private equity or venture back, maybe there's some convergence, maybe not. But generally speaking, your traditional VC guys, they want to invest in a startup that. I mean, there are startups that are maybe venture back, and then there are startups that are clearly not something that Sequoia would even listen to. So if you went to Sequoia and said, I want to build roads, Sequoia would be like, I don't even want to take the meeting.
so that gives it an understanding. And don't get me wrong, I'm not trying to debate it here, but I'm just trying to figure out, right? It's a job profile that you're saying we don't need to be this, we don't need to be that. What is the actual profile? So let's say if I want to see whether I'm startup or not, what are the 2 or 3 things that I need to? Because before I go to Sequoia or somewhere, right, I need to understand whether I'm a startup or not. So in your view, or this whole population here, right, what 2 or 3 things I need to look at and say, yeah, this is what.
So typically it's either a tech focused startup or a startup whose success and valuation rides on it being heavily tech enabled, where tech makes a meaningful difference, or maybe even a competitive edge in the business model and the valuation working, right? So if you think about Flipkart, in some ways it's a marketplace, right? So the core product is not tech, right? Flipkart doesn't sell you tech, but it uses tech to make its business model work and the valuation grow. So that is something like a VC firm would invest in, right? On the other hand, if you were a Google in 1998 and you came up with a fundamental new search algorithm, a VC would invest in it. So
Rajat,
Yeah.
I think, whether it's a tech business or non-tech business, I think if there is a disruption happening and the party is bringing any kind of disruption in the market, and many examples we have already in India in terms of traditional businesses as well as the tech-enabled businesses. So disruption is one aspect, and the second is idea to realization is already proven. And the some kind of final product or final delivery through efficient processes or whatever, right? And this disruption may come in the product, in the technology, in the processes. And many we have many examples, unfortunately, on the technology, which was a kind of discussion Piyush Goyal and a couple of ministers had. Yeah, so that's my idea. And I think maybe
So
you
I
guys
agree
can.
with you. I agree with you. I think there are definitely examples that don't necessarily. So by the way, when I say tech, it's not necessarily software, right? So I would like, and you're right. Innovation can happen in any part of the consumption chain or the value chain, right? So it could be a
Right.
process innovation or whatever. So fundamentally, if you're doing a startup, you're changing the status quo, which means you're doing something different from what already exists, right? So there's definitely innovation in some form. And I would argue, like, I don't know if you can give me an example of startups that are funded by VCs today that don't have a tech component to it. Like even if you think about pharma, for example, right? That's like fundamental tech that's going in, like, so. Anyway, okay. So look,
Yeah,
maybe come back to this question.
correct.
Let's
Yes,
move on,
correct.
right?
Okay.
Or maybe the right way to think about it is, look, I mean, it's the 80-20 rule. 80% of what's driving the money flow and the buzz around startups as an ecosystem is these kinds of startups, and yeah, there may be some exceptions. Yeah, so maybe let's leave it there for now. Okay.
Sure. Yeah.
So the next thing I just wanted to touch upon is, there was some recent discussion about what's the motivation. I think Mayank or somebody did a poll as well as to like why people want to participate, etc. And really what drives, the only thing that drives the startup ecosystem is money. Anybody who says, my motivation is not money, they shouldn't be a founder, right? They should just go do something else. Okay. Now I do have a little bit of a subtext there which says, money is the motivation, but it's not the goal. What I mean by that is, a founder shouldn't be chasing money as his or her goal, but certainly the reason for a founder wanting to do a startup, it cannot be that they cannot not worry about money or not want to make money. Okay, and the fundamental reason for that is actually capitalism. It's like if there is no money in the system, then nobody really has an incentive to make anything work. If you think about the VCs, they take a huge risk putting in money into startups. If they do not think they're going to make multiple X returns, then they're not going to pour in the money, right? So, and by the way, I mean, I also have one other subtext there that basically says, look, I keep hearing every now and then that the Modi government is promoting startups and all of that. Governments have no role in a startup ecosystem, and governments fail miserably anytime they try to do startups. And the simple reason is government doesn't have the expertise, and frankly, they don't even have an incentive. Doing a startup is purely a commercial activity, and there is absolutely no role for a government.
Again, counter question on this one is, I see some of the startups which is they have great ideas and they are very potent ideas, I will say.
Mm-hmm.
And at that time, they don't know what X they can be converted to, and still there are VCs backing those things.
Yeah.
Second is, yes, I mean, if we say money is the motivation, then business is all about money, right? So it's kind of very different for me personally is to differentiate between what we are saying when we are saying startup. Because do I need to have real good idea, which is potent, and which can yield money at some point in the future, of course, or is it scale, is it disruption? I mean, I'm just trying to still figure out that.
It's all of that. So we'll get to that. So that's a really good thought, and it's all of that, and we'll spend some time on it. Right? So let's talk about the three primary factors that go into this whole startup game, right? So you've got the startup itself as an entity, you've got the founders, and then you've got the VCs, hopefully at some point, right? So let's just touch upon each one of them a little bit. So what is the goal of a startup? Literally, the goal of a startup is to stop being a startup, right? So when does a startup stop being a startup? Anybody want to have an opinion on that? So the previous person who was speaking, he was saying something. Hey, if I have an idea, I see VCs funding it, but then do I have to scale it? Do I have to what do I have to do? Like literally, that is when you're doing that, you're a startup. The minute you stop doing that, you're no longer a startup. So what does it mean? So for a startup, the transition point between a startup and a large company, right? So a non-startup and a startup, right? Is fundamentally a startup is forever in search of a business model that can be monetized, it can be scaled, and it can be repeated. The minute you find that, and some people, in some ways, you can also call it product market fit, but it's a little bit more than that. But the minute you find, hey, here's a business model that works, I can sell this product, this is how I go to market, with this kind of pricing, with this kind of positioning and marketing. And by the way, now if I just pour more money into this, I can scale this, I can go to new markets, and I can keep repeating this as I enter new markets or even with my same customer base. The minute you find that, you're no longer a startup. Then all you have to do is you basically bring in growth capital or you go IPO, you bring in tons of people who are very good at marketing, very good at sales, very good at what have you, right? And literally pour money at it and scale the heck out of it. Now you're a big company. So really the goal of a startup is just to stop being a startup. Does that make sense?
Yeah, sorry. My name is Madhvendra. I'm just going back. So I'm saying whatever is not monetized, probably disruptive or something, whatever is not monetized, an idea, right? Which is not scaled yet, not repeatable yet. If I add these things now, then basically I can turn it to be a large enterprise in some time. And that's what probably is one of the definition I'm coming out with. I have an idea, strong idea to disrupt, to scale, and scale by repeating or something, and I put more money so that I can scale, and that's where I get the economy, right?
So I think once you've proven that hey, your business model is monetizable, scalable, and repeatable, you're no longer a startup.
So Rajat, when you say monetizable, what's the definition of monetizable?
Yeah. So the simplest is well, it could be all kinds of financial metrics depending on the stage of the company and the industry you're in, right? So either you're already getting money in the bank, so you're generating revenue, right? It could be, hey, you're generating revenue and you're profitable, right? It could be, hey, I'm not really generating money, but I have the potential to generate lots of money, right? So I would say the third one, probably you're still a startup, but you could be a very, very large startup or a very, very valuable startup. And I'll touch a little bit more upon that in future slides.
Yeah, so let me take it to the next level, right? So I'll give you one example.
Yeah.
So when we try to sell the services or the product that the customer, so there is a ticket, a ticket price for each unit what we are selling, whatever the service, right? That ticket price can be $5, can be 50, or maybe can be 500 for that one sale, which is obviously it has to be adaptable also at the same time. It should be monthly or something like that, right? So initially in the beginning, for the first month, second month, or maybe in the first year, that monetization is not sizable, and we might not be able to comprehend our expenses even, right? So we know there is a traction and all that, and we have some kind of movement happening and all that. Now, when you go in front of the VC or venture capitalists and all that, right?
Yeah.
So when you show it to them, so that is the point that I'm asking. Monetizable is that small runway I have it. So can I show trace it down saying like we can jump so high or something like that? that would be may or may not be valid, or then how much can we wait onto that to come to a point where it's like, oh, now is the right time to go to the VC.
Yeah. Okay. So that is not the point I was making here. This has nothing to do with when you should raise money. All I was trying to say was, hey, when can you, a startup could still be privately held, but not be like a company could still be privately held. They haven't gone IPO, they haven't been acquired, but at some point they just stop being a startup, right? So that's all I was trying to say here. As to your question, just hold on to that thought. I'll just get to it very, very quickly.
Sure.
All right. So moving on. So we said, okay, what is the goal of a startup? What is the goal of a founder? Really, the only goal of the founder is to maximize the valuation of the startup, right? So does everybody, or do you understand what valuation of a startup is? What does it mean? Yeah, can I assume everybody understands that? Okay.
That's very tricky, actually. Yeah.
Okay.
That's not so easy to understand.
It's actually very easy to understand.
Okay.
So all that means is you have a startup. If you want to go sell it to somebody today, roughly what is the value you would get for it? Okay, it's simple as that, right? So the only goal, so valuations. If you look at it, there are multiple $3 trillion plus companies in valuation today. They are public companies, right? So if you look at companies like Nvidia, Apple, so on and so forth, that's the valuation. But you will almost never hear anybody talk about the valuation of Amazon or Apple because they're not startups, right? They're like huge, mature public companies. So as a financial metric, the really most important financial metric for a startup is the valuation. So it's not revenue, right? So whoever was asking that question earlier or making that point earlier about this is how I'm monetizing or whatever. So it's not revenue, it's not profitability, it's really just valuation. And I'll explain why.
So, Rajat, can you take a one simple example just to say, like, when you say valuation and please.
So does anybody here know who bought? So everybody knows Instagram is owned by Meta. How much did Meta buy Instagram for? Anybody knows?
Was it $1 billion?
It was $1 billion, right? With a B.
Yeah.
Meta also bought WhatsApp. How much did they buy WhatsApp for?
18 billion, I believe,
Yeah,
17 or
close,
18. Yeah.
close, $19 billion. How many employees did Instagram have when they were bought out?
Under 50?
Yep, 13. How many employees did WhatsApp have? 55, right?
Yeah.
So now you should ask yourself, why did, and at the time, Instagram had nothing. There's no real tech there, right? So it's not like they solved a tough tech problem. There is no tech problem that they solved, right? They've got 9 employees. They had zero revenue. So why would Meta pay $1 billion? But that was the valuation of Instagram.
User base.
Right? Yeah. So we can come up with all the reasons that go into valuation. But I'm saying as a
I
founder,
know one question here.
yeah.
Like how any company got evaluated? Like who evaluate them? Like this company is the such kind of $1 billion company or unicorn, something like this. Like who evaluate those companies?
Yeah.
Those startup.
Yeah. So I'll give a simple example, and we can always get into details later on offline if you really want to understand that. So look, I mean, public companies, we all know that the valuation is done based on stock exchanges, right? So how they're traded on the stock exchanges. At the end of the day, regardless of whether it's a startup or a public company, the valuation is done by the people. So an example would be crypto. Crypto has really no intrinsic value. It's got zero intrinsic value, but people put a valuation on it, right? So you buy and trade in crypto. But anyway, when it comes to startups, there are multiple proxies that you can, depending on the stage of the company, that you use to kind of estimate. But generally speaking, the valuation of a company is established at a couple of different milestones. One is a VC puts in money for the first time, right? So let's say a VC gives you $10 million and says, I'm going to take 10% of your company. So if $10 million got them 10% of your company, then your valuation at that point was established as 100 million, right? Now, if Facebook comes and buys you out at $1 billion, your valuation is again established at $1 billion right there, right? Now, how do VCs and how does Facebook decide? The way they decide is very different, and we'll get into it a little bit, right? But does that make sense for now?
Now, one question, Rajat. So, when
Yeah.
we are saying, okay, your idea is monetizable, your scalable, and then repeatable, right? It's no more a startup. But then here we are saying that startup will only have some valuation, right? So, with this idea, those companies will no more be startup, right? We'll not call them startup.
So valuation is there both for public companies and private companies, right? I'm saying like the goal of a founder, a startup founder, is to focus on, look, once you crack this monetizable, scalable, repeatable model, really the metrics change, right? So what is driving your valuation now is, hey, what is the revenue I'm getting? What is my revenue growth, right? What is my margin? What is my profitability? And if you go public, then really your stock exchanges, those are the metrics they're looking at. They're not really looking at your valuation. That is not what influences the stock price. But for an
Is there
early
any kind
stage,
of, yeah,
go ahead.
is there any kind of, let's say, formula based on which we can kind of roughly try to calculate the valuation of an organization?
So there is no strict formula because I mean this is a privately held startup, right? But there are proxies, and I mean the industry term for it is called they call it comparables, which is because VCs and people who are in the startup ecosystem, you can approximate and you can say, okay, this startup, given its stage and the traction it has and the kind of tech they have and blah blah blah, is roughly at the same stage as this other startup that already raised $10 million at for 10%. So roughly this stage of startup, the valuation could be between I don't know 80 to $110 million, something like that, right? So that's how VCs establish it, right? And again, at this stage, that is a widely negotiated number. So if you're a hot startup, you can negotiate. You can say, hey man, like if you're going to give me $10 million, I'm going to give you 5%, right? So really the valuation should be 200 mil. But if you're desperate for money and the VCs have a lot of other folks that they're interested in, then they'll be like, okay, I'm going to give you $10 million, but I want 20%, right? So there are approximations and proxies, but there's no strict formula here.
Yeah,
Got it.
just to add, Ajay,
Yeah.
for any revenue-based startup, so generally they used revenue multiplier or EBITDA multiplier, as Rajat sir has suggested. These are comparable,
So again,
right, in
I
industry. So
no, that actually doesn't hold true for startups. Now, very very large venture. So okay, so let me flip over. Oh, okay. So let me flip over to this slide. Can you see the slide? How does a founder increase valuation?
Mm-hmm.
Okay. So for large companies, whoever was speaking is right. Those are the metrics that come into play, which is so if you wanted to go and I don't know buy Reliance out, right? So you would say, okay, how much revenue do you make, and what sector or industry are you in? So okay, you're in retail. Typically for retail, if I want to buy a company out, I'm going to do a 3x revenue multiple or I'm going to do a 5x revenue multiple or whatever, right? So there are like well established norms. And it says, okay, if Reliance is doing $1 billion in annual revenue, if I want to buy Reliance out, I'm going to pay $5 billion and acquire them. That math does not apply when it comes to the startup world. And an example there would be WhatsApp and Instagram, right? You buy Instagram for $1 billion with zero revenue. You buy WhatsApp for $19 billion with zero revenue.
so sir, I said if companies already have revenue, running, and these are the multiplier which exists, right?
even if they have revenue.
Definitely for startup, there are, yeah, for startup it's different. I
Correct,
said
correct,
revenue, those companies have revenue,
correct.
right?
So public companies, right? So like a startup. So
It's
I
not
mean,
about public or private, it can be either.
no. Okay, so that's an important distinction, right? And it's fundamental to how startups work. So have you heard of Cohere, the AI startup?
Cohere Healthcare?
Yeah, no, Cohere AI.
Heard Cohere.
Yeah, they
Yeah.
have a foundation model, right? So what is their revenue today? Their revenue is 100 mil. What is their valuation? Their valuation is $6 billion. So it's a startup that is generating revenue. It's generating $100 million a year. If you apply a revenue multiple, they should be worth $500 million, but they're worth $6 billion. So those, what whoever was speaking, you're right. Those EBITDAs and revenue multiples apply, but they do not apply to the startup world. They just don't. Right? Anyway, I mean, we can, if you can come up with an example, that shows otherwise, we can always discuss it. But this is just very, very fundamental to how the startup ecosystem works. And it's fundamental because I'm actually saying founders should not focus on revenue, that they should just focus on valuation. And for a startup, your valuation does not necessarily come from revenue. So, what are the sources of valuation for a startup? So, we've said, look, the only goal for a founder is to increase valuation. What drives valuation up? In some cases, it could be cash flows, but typically that doesn't happen until, like, you become a very, very large startup. And I would argue you're no longer a startup at that point. So, like, if Flipkart, I don't know if Flipkart is a public company or not today in India, but if Flipkart wasn't a public company, then if somebody wanted to buy Flipkart out, likely they would the valuation math would involve some kind of a EBITDA multiple or a revenue multiple or something. Okay, but really the two metrics that really go into feeding the valuation is, one is your technology and the team that goes with it. That's one. The second is, you may not be making money now, but it's your, what kind of distribution do you have, and what kind of potential for future cash flows you have. So that is really what led to, and somebody on the call actually said that, and they were right, that the reason Instagram got bought out for 1 billion and WhatsApp got bought out for 19 billion, they actually didn't even have cutting edge tech, right? It was simply they had the eyeballs. So Meta was like, hey, I don't worry about whether you're making money now or not, whether you have revenue now or not. You've got distribution, you have the user base. I'll figure out how to make money later. Does that make sense?
Yes.
Okay. All right. Um, okay. So coming back to what is the goal of a founder is really to maximize the valuation of a startup. The second is extend runway. Basically, can you make your startup survive for as long as possible? Right? Because if you're a passionate founder, if you're working hard at it, and you're generally a smart guy, at least average plus, if you have a long enough runway, then eventually you'll figure out what works for your startup, right? And the last one is to really minimize risk, which goes into giving you a long runway. And depending on the stage of your startup, there are all kinds of risks that you're going to take, or sources of risk. Initially, it could be market risk, which is really like, are you in the right space? Are you solving the right problem? It could be tech or product risk, which is like, you may be in the right space, but are you able to build the right tech or the right product? Right? It could be financial risk. Look, at some point you're going to run out of money or you need more money. So there's financial risk. And then there's people risk. As you kind of start scaling, even going from like a 2-person team to like a 10-person team, do you have the right people? So really the goal of a founder is, let me also minimize risk. Okay, I'm going to quickly go through this. Essentially, you've got to have a lot of passion. You've got to be able to hustle. Do people understand what hustle means? So hustle can sometimes be taken as a negative word in the startup world. You have to be able to hustle, which is you've got to kind of cut corners and come up with like creative ways to make things happen. Call it jugaad, call it whatever. So I'll give you an example. When I was doing my startup and I needed to meet with senior execs at large companies, I was like, they don't know who I am, they don't know my startup, and like, why would they take meetings from me? So at the time, the first iPad was about to be launched, but it wasn't launched yet. And so I would send emails to these people, and in my email signature, I would say, send from my iPad beta. And I can't tell you how many meetings I scored, not because these people wanted to meet me or understand what my startup was about. They were like, इसके पास iPad beta कहाँ से आ गया? And like, अभी तो release भी नहीं हुआ, and like, can I get a look at his iPad beta? So just an example of a hustle. Grit and determination, ability to take risk, uh, be open to feedback. And I think a lot of founders, somebody was earlier talking about ideas, and I think ideas are a dime a dozen. There is not a single idea that any one of us will come up with that at least a million other people on the planet haven't thought about, and 100,000 are either working on it or they've worked on it and given it up. Right. So I think being very open to signals or feedback that either the market is giving or the customers are giving or ecosystem is giving, and taking that feedback and be very open to make adjustments to your original idea and not really be tightly wed or passionate about the idea itself. It is a lonely journey. You will have a team, but really the sources and sinks that you go through as a founder, if you have a co-founder, you can probably share with your co-founder, but at the end of the day, you're very, very lonely because there are things that nobody else will understand except you. So you have to be willing to accept that. Um, the next one is actually along the lines of the previous one, which is be humble. I mean, know that there's a lot of learning involved in the path. And the last one is it's all about action. So if you think about what I said on the previous slide, it's about extending runway, right? So what that means is if you have a certain amount of time until which you can sustain your startup, you've got to do things as quickly as possible. And frankly, the market is very, very open to accepting imperfections. Uh, I mean, we assume that if you put out a bad product or a product that is suboptimal, customers won't love it. I'll develop a bad reputation. My brand will be hurt and all. Startups have no brand. Anybody who thinks like startups have a brand, they've got zero branding. So I think imperfections are very, very okay. It's all about getting the product out there as quickly as possible, learning from it, and then coming back and either doubling down on it or changing gears and building something else. Okay, let's talk about how VCs operate. Uh, Essentially, what VCs do is they give you as a co-founder of a company, they give you money in return for a share of your company, right? And that's typically called equity. The way their business model works is, on average, if they put money in 10 companies, they're probably going to lose money on about six. They are going to get their money back on maybe one or two. They might make like 3x or whatever on like maybe one or two. And what they're really hoping is that they're going to make like 50 to 100x, maybe even 1000x on one of those companies. Okay, so that's really how that works. Um, what are they betting on really? That really depends on the stage of the company. And I think we were kind of noodling with this a little bit earlier in the discussion. Uh, Let me see. Okay. So, so depending on the stage of the company and what your startup is about, they're really betting on different things. So, literally the first stage of a startup is that you come up with an idea and you want to build a proof of concept. It's not a real product. The tech isn't refined. The product isn't the cleanest. you don't have pricing, you don't have marketing messaging, so on and so forth. And really, that's where you as a founder, you're putting in your own sweat equity. You're incurring the opportunity cost of not having a corporate job, and you're working on this full time. And then maybe your brothers, your sisters, your parents, your cousins, your friends, they'll be like, hey, okay, we are supporting you. We really don't care about the idea, or we don't understand the idea, but we know you, and so we're going to put in some money. Right? That's really about building a proof of concept. The next stage over is the proof of concept allows you to actually go out there and talk to people and validate your idea, or at least gauge some validity with a real prototype rather than just हवा में बातें करना, मैं ये बनाऊंगा या वो बनाऊंगा or whatever. Right? The next one is really building a functional prototype. And that's where you say, okay, I think this thing has legs, and let me build something that I can actually start to collect feedback on. Right? And that's where you would actually go raise an angel round, which is typically debt. So an angel round would be not your family and your closest friends, but 1 degree of separation away. So you might come to the HBTI folks here and you might say, hey, I'm raising $500,000 as an angel round. Will you guys put in some money? Right? And typically at that stage, there's no valuation for your company, right? Because a valuation event hasn't happened. A VC hasn't put in money, nobody's bought you out, you haven't gone public. So it's typically a debt round, which means, if I give you $10,000 in return, you as the startup founder tell me, okay, you know what, in 2 years' time, I'll give you your $10,000 back and I'll give you 5% interest on it. And by the way, or I'll give you the option that the next time I raise money, when I go to a VC for Series A, whatever the valuation they place on the company, I'm going to give you a 20% discount on their money. Right? So that is the next stage. Uh, the next one is a Series A, and typically a VC enters at Series A, although sometimes they can enter at a seed round. So what is a VC really putting money on? They're really putting money on one of two possible things or both. Either either you have a lot of credibility as a person, right? So credibility could come from two sources. One is you've been a previous founder, so you've done it before. So you go to a VC and the VC is like, okay, at least this guy doesn't have to learn about what it means to be a founder. They had a reasonable degree of success, maybe not a stellar success, or maybe they had stellar success, right? So they're like, okay, got it. I'm betting on this person. Or you may not have done a startup before, but you're the AI guru, right? So somebody who's the AI guru, they may not have done a startup before, but they come out and they say, okay, I'm going to build a startup and I want to raise $100 million. And a VC will be like, okay, got it. Here's a check, right? So, uh, so they are either betting on the person, and when I say person, it's persons, so co-founders and maybe your core team or whatever, or they're betting on a combination of, yeah, okay, we believe the person has reasonable credibility, but we won't write a check simply based on the person's credibility. We also like what they're building and what is the progress they've already made in terms of building the early tech, the functional prototype, and whatever else. Okay. So the next stage there is, so at Series A, VC is saying, "Oh, yeah, got it. You've shown commitment. You put in some money. You put in sweat equity, all of that stuff. Let's give you a check. And what we want you to use the check for is to go enhance your tech and build a real product, not a prototype, right? So that is what Series A money is for. The Series B, the next time you're ready to raise money, what they're saying is, okay, let's expand the product in the tech and start looking for a product market fit. Okay. Series C is you think you might have reached product market fit, and it's literally more money for you to validate product market fit and validate your business model. And anything after Series C is basically growth equity rounds, right? And those can be endless. So let me pause there. Like, does that answer your question about what VCs are betting on and what do they look for?
Yes.
Okay. All right. So now the quick lesson in history. So what is VC? venture capitalists are a bunch of finance professionals. Back in the day, they were all bankers. And then somewhere around the late 70s and the 80s, some of these bankers who had made money on Wall Street and so on and so forth, they were like, oh, there's this new thing starting in this area called Silicon Valley, where really the entire place is full of fruit orchards. But there are these companies like Intel and like the early semiconductor companies. That's interesting, and let's go see what this is about. So that's how VCs actually moved from the oil bankers and the traditional bankers, and they came to the valley and they were like, okay, we'll start investing in some of these semiconductor companies. Uh, and then, of course, as the startup ecosystem evolved, it's not just an Intels and all; it's a bunch of software companies as well. Uh, so at the end of the day, these are bankers who essentially write checks. Now, where the Silicon Valley stands today is that at some point the power balance started tilting, and the founders were like, "Wait, what is the value of VCs adding to me? All they're doing is writing a check, right? So if I go to Kleiner Perkins versus Sequoia versus I don't know August Capital or whoever else, at the end of the day, a check is a check is a check is a check. So the valuations of these startups that started to emerge from the Silicon Valley, they were so huge that I mean these guys, the VCs were making more money than they'd ever made in investment banking on Wall Street, on Wall Street, right? And suddenly the founders were like in a position of power over the VCs where they were like, what value are you adding to me? You're writing me a $10 million check? Yeah, well, there are 10 other VCs who are willing to write me a $10 million check, right? And then there started to be repeat entrepreneurs, people who had made money from their previous startups. And then when they build their next $1 billion company, they were like, I don't need a VC. I'm just going to put 5 million of my own money. And you know what? My friend who also made $10 million, he's going to put 5 million of his money, right? So this term about dumb money started to come around, which is like VCs don't really add a lot of value except that they're writing check. So if somebody else wrote a check, then what do you need VCs for, right? So I think where things are currently, there are some VCs who you could consider as dumb money, but some are not. So and things got so desperate in the valley for venture capitalists where I mean all of you have probably heard of eBay, right? So when eBay was raising money, this is in the late 90s, there was a well-known VC firm called Benchmark. The only reason they invested in eBay was because no other company was willing to invest in eBay. No other company was willing to invest in eBay because internet was so new, and eBay was saying, hey, you know what? You can just do auctions on the internet. And every other VC firm, they were like, that concept is stupid. Like why would we invest in that? And Benchmark didn't believe in that concept either. The only reason they invested in eBay was because these VC firms were feeling the pressure to distinguish or differentiate themselves from the other VC firms. We're like, okay, we don't just write checks like the other guys, we are a different kind of a VC firm. So they actually ended up investing in eBay, and of course, they ended up making 10,000 times ROI on their money. But that just kind of, that's the drama side to the Silicon Valley. Now, on the VC side, there are instances where, well, there's at least one instance I know of where a partner at a VC firm shot himself in the head because the founder of a very, very successful company refused to take his money. And he was under pressure from his own VC firm. Uh, like, it's like, hey, why are you not able to invest money in this startup? That's a super hot startup, and we invested in this previous startup, so we already have a toe in the door. So like, so the guy ended up shooting himself. So anyway, more on that later. Okay, so we talked about this one. So a quick story for my own startup when it comes to VCs. The first time I started meeting with VCs was when I didn't actually need to raise money. And the reason I started meeting with VCs was because I wanted to understand how do these guys look at things? Like, what is the kind of feedback I'm going to get, right? And the first VC meeting that I had, I remember I got an introduction to a partner. I'm not going to name him or the VC firm. But typically, VCs have a lot of money. So when you walk into their offices, it's all wood paneled, heavy oak, and all of that. So kept me waiting for 15 minutes. Then he showed up, and he's like, "Hey, sorry, I'm late and all, or whatever." And I gave him the pitch. So I had like 5 slides. So I gave him the slides, and I also had a functional prototype. So I gave him a demo on an iPad. And at the end of the meeting, he says, "Well, okay, I'll consult with my partners and see if I can invest." So I said, "Well, I'm not looking for money." So his jaw literally fell, right? Because they assume that everybody is just coming to you for money, and they want to be in that position of power. So he said, "Okay, so why are you here if you're not raising money?" I said, "Well, I'm just learning. I just wanted feedback. You're a smart guy. You invest in lots of companies. So what do you think of this? Like, and what would be your advice for me?" So he gave me some advice, which is a different story. But I left, and the next day he showed up at my office in my startup, basically saying, "Hey, look, I know you're not looking to raise money, so we can always put VC money later on, but I want to invest as an angel investor, and here's a $50,000 check." Right? So just a funny kind of a story as to how the VC world works. Okay, so we talked about these. We're not going to get into this. We talked about this. So just a quick time check. So this is taking longer than I'd assumed. I think it's an hour already. Uh, Mayank, should we just break here and then continue next time, or what do you want to do? Or we can just pause here for observations and Q&A if people want to do that. Well, there are definitely more slides, but anyway, I was going to switch. We are at the point where I was going to switch and kind of tell the story of my own startup, but I mean that'll take time. So like, we can either just close the session here, or if people have a few questions or observations, discussion
So
points, we
Rajat,
can do that.
what I feel that I think there is enough momentum. People are interested. They are in a zone. They're asking questions and all that. So with this movement, I think if we can push it forward and complete rest of the stuff in one go is good enough. Who knows that in the next call who will be able to make it or no? But right now, people are vested into it. That's my point of view.
Yeah, I'm fine with going along, and I mean, if people want to stay, they can stay, or if they want to drop out, of course they can drop out.
Can I suggest, like this is Smita, thank you, Rajat sir. Can I suggest like maybe a quick round of Q&A on the first,
Yeah,
and then
yeah,
we can proceed with
yeah, sure.
there's a lot of good stuff you covered, and I know people may
Yeah,
have questions.
sure.
Yeah, hi. So I have one question.
Hmm?
So what kind of support you are providing or you can provide to our SBT family if someone has already something that like want to build, or someone has something that already built and it is in place, and also have some functional and already like live for the users. So what kind of support you are
Yeah.
providing and you can provide to us?
Uh, yeah. So look, I'm just doing this because this is exciting to me, and I want to learn more about the Indian startup ecosystem, right? But I kind of had this slide with some takeaways, and one of the things I have there is, hey, like if you don't have a co-founder, get a co-founder, and if you're a new entrepreneur, then get an advisor. So I do advise startups. I also do some angel funding. Uh, so I'm open to being an advisor. Uh, of course, like there has to be a meeting of minds, and like I have to be excited about what you're doing. You have to be excited about me and understand that I can add value or not. So I'm open to that idea. I think the other thing that is a loosey goosey idea in my head right now, it's not formalized, so I'm a little hesitant to talk about it, but I'll tell you what it is. I've been noodling with the idea of setting up an incubator based in India. Right? So, I mean, it's not there yet, but that's something I'm considering where I would probably take like maybe 2 to 4 startups as a batch into the incubator, and then work very closely hand in hand with the founders on their startups. Aside from that, the
Yeah,
support I can offer
if you
is
have
just free
something
advice.
on incubation, because I am incubated in one of the oldest incubator in India,
Yeah.
so I know that ecosystem. Definitely, we can exchange synergies there.
Yeah.
Yeah, this is an exciting field.
Sure.
And do we have any WhatsApp group wherein we can ask some quick question? I mean, I'm not part of it, so just want to check like if at all we have any WhatsApp group.
Okay, so I'll tell you what worked for me as a founder, right? So earlier I was trying to make the point that your journey is, I mean, get used to loneliness, right? So I had 3 or 4 mentors, advisors, whatever you want to call them, and literally like once every 2 weeks, I would just go out with one of them, and it wouldn't even be like, here's a question. We'd be like, okay, let's go get a drink, or here's an interesting movie playing, let's go watch a movie, right? Or let's go, here's a new restaurant that's opened up, let's go have a meal. And literally, it was like spending time with that person, and naturally, the conversation would just flow to random topics about things that we were doing because we were both interested in startups, right? And I think it was, look, I mean, there are times when you will have a very specific question. It's like, man, like, I really want to get into this company. Do you have a contact there? Like, do you know somebody you can make an intro to? Or it might be like, I'm really trying to crack this sales channel and I can't get in. Like, what am I doing wrong? Right? But for me, the most useful things were uh, learning over a period of time by slowly and incrementally spending time with people who had done this before and then learning from them. And as to your question about WhatsApp group, I think whoever the previous person was, I think they mentioned they're part of an incubator. I'm sure there are probably WhatsApp groups where people will answer your questions.
Thank you.
Yeah, but
So
generally
I
that's
think
a tool that I don't think would work well for startups. Because, I mean, startup topics and questions are so one-on-one that I don't know if you want to ask those questions in a WhatsApp group. Not because of secrecy or anything. I just don't know that there's value there.
Sir, regarding your idea to set up an incubator in India, is there like any specific motivation for that as of this moment? Why not in America itself, or back in Silicon Valley itself?
Well, one, I mean, there are lots of incubators and accelerators here in the Silicon Valley anyway. Uh,
Mhm.
Two, like I have a specific interest in the Indian market, right? I think there's a lot. I actually have a slide on the Indian context here, which is interesting. But so Indian market is of specific interest to me. I think the ecosystem is very raw and very nascent. So there's typically like if you're in a new land, there's opportunity to make more of an impact. So that's why I'm interested in the Indian market, and that's why I want to set up an incubator in India.
I see. I see. Thank you for answering. Yeah.
Sir, I think you answered this question, but a little bit more specific. When you're trying to do something for a long time, like when you lose momentum, what's your best advice?
Uh, well, I think you have to introspect why you're losing momentum. See, if you're not doing your startup, okay, so generally speaking, you really have to do your startup as a full-time job. Or even if you're doing a job on the side, you have to be very clear and committed in your head that your number one priority is your startup. Your job is just a way for you to kind of pay your bills for now. But then it's very much like hey, I'm going to go in at 9 a.m. and I'm going to come out at 5 p.m. And that's it. The rest of the day, I'm just going to work on my startup. So I'm not saying that that's what might be happening with you, but you have to introspect and say, hey, why am I losing that momentum? Am I no longer passionate about this? If I'm not passionate, it's the five whys, right? So it's like,
Mm-hmm.
am I not passionate? If I'm not passionate, why am I not passionate? Is it because I don't have belief in myself? Is it because somebody else is not believing me? Is it because or whatever reasons, right? So what I've found is that I get passionate about different things, right? So like, I'm like, if suddenly sales is happening, I'll get passionate about that, even though I'm not a sales guy. But I need something. I need some problem to challenge me to keep me motivated. If there is no worthwhile challenge, and or it's a very abstract problem like, oh, I've just lost momentum, like that doesn't keep me motivated. So I think you really have to introspect, like, why are you losing momentum?
Thank you. That makes
Can I
sense.
add one thing? Yeah. So Ashwinta, you can ask yourself why you started, right? And if your answer is still valid to you, why you started, and it is still exciting you, then probably you'll find a reason to motivate yourself again. Because then it happens in long journey of startup. So everyday energy is not same, right? You need to figure out what works for you, what giving you another kick, and you keep finding those moments.
Thank you.
Yeah, Lokesh, I totally agree with you. Right. So the startup starts with a validation of an idea. That's the very first step. But after a few steps, you go forward. Now that we need to go back and revalidate the idea. Now that whether the point where I started from is still valid or so, right? And that is going to make you more motivated. Now that on every day when you go out and reach out to your customer or your audience or so, there'll be enough out there to demotivate you. But as long as you are revalidating your idea and coming back again and again, that's gonna make you motivate again and again. Get up in the morning, depressed in the night, get up in the morning, get motivated, and go out and fight. That's gonna make it happen.
Thank you. I really appreciate everyone's responses. At least it makes you feel like you have a community you can go and discuss.
Yeah, yeah, Smita, because I can tell you because I'm going through the same phase right now. And once in a while, you get so depressed when you sleep in the night. It's like, oh God, like what I got into it. Next day morning, you pull yourself again because there's no other choice. Because I know my idea is good. You go out and fight again. You see if you wins, motivate it, and get back into the
Oh,
fight.
so I think I'm sorry. Is that Lokesh speaking?
No, that was Ashwani,
Okay. So
but
I
earlier it
think
was Yogesh. Yeah.
okay. So I would if you're kind of experiencing what you said you're experiencing, I would question myself and say, am I working on the right thing? Right. And I'll tell you why. Like, look. I mean, all the I don't know if you can see the slide I have up right now. Can you guys see that? Focus on the right problem.
Yes.
Okay. So the quick point of that is, look, as a startup and as a founder, the odds are stacked against you. You don't have money. You're trying to do something that hasn't been done before, or you're trying to do it differently. You need people who are smarter than your average corporate employee, but you can't pay them more money. So like the odds are really stacked against you. So the best way you can set yourself, and like I said, I mean, there are only two potential successful exits, right? Either somebody acquires you or you go IPO. Very few companies go IPO. So the really your best bet is, how do I get acquired? Now, to get acquired, some other large companies have to care about what you're doing, right? So I think, like, if you really want to set yourself up for success, there are a couple of things that you want to think about. One is, when it comes to business, there are only two emotions that work. I think it was Paul Ecking or somebody, the psychologist, who said, like, humans have six basic emotions, right? But when it comes to business, there are only two emotions that work. There is fear and there's greed, right? So uh, if you think about why Facebook bought Instagram, it was fear, and why they bought WhatsApp was actually greed, right? And we can get into that, right? But the other is, like, focus on the right problem. What that means is that a problem that a lot of people really care about and are passionate about? And are there large companies with tons of money fighting it out amongst themselves for it? Right. So what would be an example of that? So if you think about uh, when mobile came around, there is not a single company in the world that wasn't fighting it out over mobile. There was an iOS war, there was an Android war, and then Microsoft got into it, building their own OS. HP started building web OS. Nokia started building that. Like everybody wanted to build a mobile OS. Everybody wanted to build a mobile device, and everybody was fighting it out like crazy, right? So what happens is when these big companies, when they start fighting with each other, it's like big tectonic plates on the planet, right? On Earth, clashing with each other. And when tectonic plates, clash, there are these fissures or cracks that start appearing. And when those cracks appear, that's an opportunity for a small startup to kind of creep in between the crack and then claim that space and then start to kind of expand, right? And then what happens is all these 4 or 5 or 10 big companies that are fighting it out amongst themselves, either somebody's fighting it out for fear or somebody's fighting it out for greed. And somebody's going to turn around and pick you up or acquire you. So I think the reason I said what I said initially, Ashwini, was, if you're experiencing that, like you want to ask yourself, are you in a space that is hot enough, where there's enough action, where it's like there should always be 10 things on your to-do list, which is like, man, if this doesn't work, I have to do this. If this doesn't work, I have to do that or whatever. And if there are times when that's not working, then one, I mean, I'm not saying that is exactly the reason, but that's got to be one of the things that you should think about.
I think that's a
Yes.
super helpful feedback, sir. And like, are there ways to validate your idea early on?
Yeah, absolutely. So, I mean, one is it's very easy to recognize. I mean, when 2007 the iPhone came around, I, I mean, you could. So I have a YouTube link. You guys have. Let me see if that plays. Have you guys seen this clip of Steve Ballmer, who was the CEO of Microsoft, laughing at the iPhone when it first came out? I don't know why. Okay, there. Oh, okay, okay. All right. So you guys can just Google it up. It's like a less than a 1 minute clip, right? But I mean, look, I mean, some of these things are very obvious, right? So, like when the mobile wars were happening, everybody was involved, and half those companies don't even exist anymore, right? So some of those signs, I mean, learn to recognize those signs. Second is, I think another thing to look out for is, look, every few years there's a new mega trend in tech. But once a decade or so, there's what we call an inflection point, where things drastically just change compared to how they happened before. And some examples of those would be, look, the internet came out, right? I think somewhere I called them out. Yeah, the internet came out. Then there was the whole advent of cloud and SaaS, right? And you saw every company on the planet trying to build their own open cloud or whatever that was called, right? And then they all packed up and they all said, okay, fine, we can't build it. We're going to either go to Google or AWS or Azure, right? Same thing with mobile. Everybody tried to build a tablet. Everybody tried to build their own version of Android. Actually, they wanted to build their own OS. Entire companies like BlackBerry just vanished, right? Nokia just vanished before it came back in a very diluted kind of form and so on and so forth, right? So people were used to either getting their cell phones for free or paying $20 for it. And now the hottest selling phone on the planet is the iPhone, where people pay $1,000, right? Similarly, you're seeing another one, which is like AI, right? So there are a lot of companies. So if you think about a company like Adobe, for example, that is known to be the king of content creating, right? I mean, they're the ones who own, like, they used to own Flash and Action Script, so there were a lot of applications and games built on it. They own Photoshop. I mean, every large company in the world today uses Adobe tools for content creation. And what's happening with AI? you've got to question it. Like, so if I were Adobe, I'd be very, very worried. I'd be like, man, like if every Tom, Dick, and Harry can use some kind of a generative AI tool and start making images, editing images, building videos, so on and so forth, that at a minimum is a threat to me. So that fear instinct should kick in that, hey, somebody could just disrupt my 40-year-old business, right? Or now, if you think if you're somebody like Miro or some other startup that is kind of fighting with Adobe, you could see that as an opportunity to level the playing field. So if there's a startup that comes up with some innovation in content generation using advancements in AI, Adobe would want to buy them out because they are fearful. They're like, excuse my French, but fuck, if I don't get rid of these guys, they're going to kill me, right? And the other guys, their competitor might be like, oh, we are growing like crazy and like I could double my revenue, right? Let me just go acquire this startup. Does that make
I
sense?
think I think Canva is another one, right, which is kind of set to
Sure.
be disrupting this market, right?
Sure. If you look at Google, right? So for Google, the issue is if they cannot compete with OpenAI, people will stop using search the way we do it today because nobody is going to go to google.com to search. They're just going to ask questions in OpenAI, like some kind of a chatbot interface, right? So I think some of these trends you just have to recognize, and then recognize when multiple companies are fighting it out. Like right now, like companies like Amazon, Apple, Microsoft, they're pouring in like 200, 300, 500 billion dollars, right? Nvidia just announced they're going to put in $500 billion into AI. Right? So I think some of these are lay out your tech stack. We are all engineers from HBTI. So at your lowest level, you've got the chips, the hardware. So who are the players who are playing there? Lay out the next layer, which is your sort of your software infrastructure layer. Just keep going up that stack, right? You can identify the players, you can figure out who's competing, who's fighting, so on and so forth, and see if you can. See, I'll give you an example. At one point in my startup, I got a cease and desist notice from Facebook. They basically sent me a legal notice saying, hey, if you don't stop doing what you're doing, we're going to take legal action against you. And that right there is and we celebrated. We actually had drinks because what that tells me is I'm doing something that these guys are fearful of. Right? They're like, oh, if we don't stop these guys have the potential to completely disrupt us. So anyway, I think there are enough signs that you can make educated guesses and kind of figure out. And then I think the other thing you want to do is, at least as a founder, you should also always be out there wildcatting, which is like sniffing around, like talking to lots of people and, right? So it's like get your startup out there, right? People like I think a lot of people get very cagey that oh somebody's going to steal my idea or like whatever. No, it's the opposite. Like get your startup out there. Uh, don't spam people. Like it's not like mere page पे जाके like कर दो, but like go have conversation about your startup. Get feedback from the people. Like what do they think? Do they care? Are they even taking your meetings? Are they taking a second meeting after you met them once? And then collective IQ, right? Which is again, it's all about extending your runway. It's like if I want to solve a problem, I could go and try to figure out how to solve it. Or if I want to save time and effort for my startup, I'm just going to go, I'm going to say, hey, do I know somebody who's already solved this problem? Who's that person? Let me just go ask him. Right. So I think coming back to your question, like, are there signs? I think there are lots of signs and signals that the market and the ecosystem gives you. I think you just need to have a heightened sense of sensitivity to take that feedback and really kind of use it for your startup.
Thank you. I do have follow up questions, but I don't want to take all the time. I'll reach out to you separately.
Sure.
Thank you.
Yeah. Yeah.
Yeah, thank you, Rajat sir. I think it was an interesting perspective, right? Uh, and a good learning experience.
Yeah, absolutely. And by the way, I mean, you should all just, I mean, we should just call each other by our names. So please don't call me sir.
That's a hard one to change, sir.
Okay, I mean, whatever.
It's
Hello.
it's only about the time. I think time should be a little earlier.
Hello. Yeah. Hello. Hello. Yes, I am Ankit here.
Hi, Ankit.
Yeah. So actually, I am working on the same, if you know about the meta frame. So I have developed the same thing in India. Okay.
Sorry,
So
what are
I
you
want
working on?
I have developed the same meta frame in India.
Okay, I don't know. I don't know what a meta frame is, but okay.
It's like a small frame, okay, where you can directly talk with speech translation for all the Indian languages. Okay.
Okay.
So and second one is they have the capacity for like video and image processing. Okay. Third one have the capacity of the display, augmented reality capacity. So you don't have to need the phones there. You just need your smart frame. You can talk with anyone, like somebody the meetings. Okay. For first segment for audio to audio. Second segment you can use for if you are the video creator or anything, you can use a small frame and you can record any video from the frame only and directly upload on YouTube, Instagram, or anywhere. And third one is the like display capacity. So like you are driving the car or you are going from anywhere from flight or something. So you just have to wear the frame and play your Netflix or any like YouTube movies or anything on the frame only.
Okay.
Okay. So I am stuck somewhere in the hardware side. So I am looking for some help there. Okay. So I want to talk one to one actually. So I am in
Yeah,
India right now.
do that. We can offline that and talk separately.
Yeah. So I will text you on the same number so we can set up some meeting and then we will talk about that.
Sounds good.
Yeah. Thank you. Thank you for the session and thank you for the time. Yeah.
Yeah, like are you asking how to find a co-founder or what kind of qualities to look for in a co-founder? Okay. So you wanna find
That's my
somebody.
question.
Yeah, you want to find somebody who first and foremost is intelligent. They have enough horsepower or MIPS, crunching power. Like you can, you can. They're generally a smart person, right? So it doesn't have to be like a PhD in like XYZ or whatever, but is generally a smart enough person who can read people, who can like, generally solve problems, so on and so forth. Right? So generally they're a smart person. That's one. Uh, the second is somebody with the right attitude. And what I mean by that is this person has to bring their best work every day when they show up, right? So they have to come in with the right attitude, the right passion, have to have a good work ethic, so on and so forth. Right. The next one is where you want somebody who has somewhat complementary skills from you. So, like, maybe you're really good on the business side. You want somebody who's really good on the technology side. At least through that phase of the company, right? So later on, you can hire a specialist or whatever. But for that stage of the company and what you're trying to do, you want somebody who has complementary skills. Uh, and the last one is you've got to be able to hang out with this person, right? You've got to be able to have lots of honest, intellectually honest, sometimes brutally honest conversations. uh, you have to be able to fight it out with this person, knowing that uh, that fight isn't going to disrupt the company, and the next day you're going to be